Hello everyone, welcome back. My name is Greg Furman and this is the Forex Weekly Outlook for the week of December the 18th, 2017. Now this will be the final Forex Weekly Outlook for the year. As liquidity in the market dries up basically between Christmas and New Year's, we should be limiting our trading because, again, most people are out on vacation. The major banks, the equity markets are very slow, so we want to really take this into consideration. Now, exciting news that we'll be looking at here also going into the first part of 2018 is our live training room with the VantagePoint software. So I would certainly invite everybody to look into that further. Any information or about that, feel free to contact Market Technologies, and I'm sure they'd be happy to give you more information on that. So now on with the Forex Weekly Outlook. With our dollar index, we've come through the Fed here. The Fed, in my respectful opinion, has been relatively hawkish going into 2018. So, but the dollar still is seeing some headways. And when we look at this, we can see our medium-term trend is weakening. We've got resistance coming in just below the 94 mark. If we can break through this 94 area, then the dollar should extend its rally into the first quarter. Now, our neural index is switched higher, but our predicted MACD is really struggling with crossing over this zero line. But if it does, that should see the dollar extend gains. Now, on a positive note here for the dollar, we have failed to break below the 40 level, so there is very little downward momentum in selling the dollar index or selling the US dollar in general. So we have recovered, we're sitting at 57.6. Now, as the dollar has come under pressure, we can see that gold has started to rally. A nice call again here from VantagePoint. Our medium term crossing over our long-term predicted difference. That was further supported by a shift in the neural index from we've been at zero for several trading days, almost I would say a couple of weeks almost. A very nice move on the downside, but as you can see here, the same thing that would have us go short on gold, which is that signal of that medium term cross, and of course that all-important neural index is the same thing that would have us go long. As you can see, the medium term crossing back up. However, we're now encountering significant resistance up against that critical VantagePoint 18-day predicted moving average, currently residing at 1266.34. We've closed below that at 1257, and again, if the dollar is going to rally, we would like to see gold hold below at least the 1268, 1270 mark and start to move back down. So again, this move higher in gold does look corrective in nature. With oil going into the final part of 2018, we're sitting here range trading, guys, between 56 and 59. Nothing has changed here. Oil predominantly is not strong at this time of year, so the bias from the VantagePoint software is still lower, but as you can see, that medium term crossing the long term predicted difference, warning us that we're not quite ready to move lower yet. So this is keeping our equities nice and firm, and I have to say that, you know, with all of the different opinions in the market, with the different analysts, the different newsletters, etc., VantagePoint's made a very impressive call here with this S&P 500. Everybody has said, including me, that it should be going lower, and it just doesn't. So based on the correlation to the 31 other markets that VantagePoint takes into consideration when forecasting these equity markets, they clearly have an edge in forecasting the S&P. So now that we've taken a good look at the dollar index and the major players that drive the dollar, or the dollar drives them, depending how you want to look at it, we move into our main currency pairs. The Euro-US for next week here. Again, we can see a bit of a bottom forming at 117, but we've got strong trend line resistance at 119 with still a bias to the downside. Now, when we look at the indicators here, we can see that medium term crossing over the long term predicted difference, and you can see how I've connected that to a support level here at 117, but the predicted differences are still below the zero line. The neural index is turned back down. What's really going to be a decider here, guys, is if the MACD can follow through, and if we can break through 117, that's going to open up the door probably down to this area here around 115, the 115 to 116 area. Now, that's still going to be a tall order. The euro has had a very good year in 2017. Despite what you may have heard about how bearish it is, that's simply not factual, guys. When we look at the charts on a year-over-year basis, this chart is pretty clear to me that the euro is not in a downtrend. It's in a significant uptrend. It's had a fantastic 2017 calendar year. Despite the ongoing US dollar strength, the euro continues to fight the dollar. So for now and for next week's trading, our key upside resistance points are 117.82 and 117.69, and we can assess that we are closing very close to that at 117.48. So the first major hurdle is to break through there, but then we still have this very strong headwinds at the 119 area. But again, a break below 117 would trigger a very bearish move. Now, US Swiss franc, basically the same trade. Euro US goes up, US Swiss franc goes down. You can see here that I've basically tagged the resistance line here onto the VantagePoint medium-term predicted difference cross, and right now we have to break above parity. Now we're starting to recover. We could have a double bottom here in place at about the 98.40. So as long as we're above 98.40, the bias is actually still to the upside. I really do like the position of the predicted MACD and the predicted RSI. 60.7 does suggest that this pair is getting ready to break potentially back above the parity area. So for this week, again, 98.82. We've closed at 99.03, excuse me. So if we can hold 98.83, or more importantly, this level here where we can see we work in price action, as long as we're above 98.50, we are likely going to target back towards the parity level. Now, with the pound dollar for next week, much trickier on this one, as Brexit negotiations still loom and hang over this pair like a guillotine. So we've got to be very cautious here. Now, we're sitting right on this trend line support that I've drawn in. We do not have the 8-day crossing the 18-day predicted moving average, so the bias still is to the upside, but I feel we could come down and target this 132 area here, where, of course, we would still remain buyers. I am a firm believer that the British pound made the right call by entering into Brexit. It was the right thing to do, and ultimately it's going to benefit the British pound. So right now I think also that this is bargain basement pricing on the British pound at 130. I think it's grossly undervalued against the US dollar. Now, the first thing we need to do, if for long trades, we would like to retake above 133.36. But you can see we've had a bearish close of 133.19, but that's on some of the headlines with Brexit negotiations not going that well. Ultimately, I think they will come down. British pound will come down a bit lower, but it will still be corrective in nature. Only a sustained break of 132, where I've drawn in here in this current range, will that trigger a much bigger sell-off. But at this particular time, I think that's very unlikely. So keep an eye on that to begin the week. But again, we are going into ultra-thin illiquid markets into the end of the calendar year. Now, with dollar yen, I've talked about the bigger, broader range with a lot of people here about and that broader range is 114.50 to 111. Realistically, guys, there's very little reason for us to be buying yen in the current interest rate environment, the commodity environment with gold down. All of these are very big negatives for the Japanese yen, but it does show the overall depreciation, like what I talked about in last week's Forex Weekly Outlook, of the US dollar. Normally with gold at 1220 and with, 1250, 1260 on gold, and the S&P at 2650, 2680, that would realistically have dollar yen sitting at about the about the 130 mark, 135, or at least 120, and it really does show how the US dollar is depreciating. Now, if we look at this, even from the current political environment, the national debt in the US, at the end of the Bush, I think it was around 1.2 trillion. At the end of Obama, it was 9.8 trillion. And now we're going into another Republican-based administration. So where this debt is going to go is very difficult to say. But regardless of which party you're affiliated with, the U.S. is piling on a considerable amount of debt, and it is affecting the currency. And it is not the Democrats, just the Democrats, or just the Republicans, guys. It's both. Okay, so everybody loves to point fingers at this party or that party, but they're both adding to this debt, which is hurting the US dollar. So when we look at this right now for next week, we want to retake the 112.68 area. Very, very important that we get back up above this this particular area. If we have any shot of retesting the one back up towards the 114 area in the first quarter. So the indicators from VantagePoint again are very mixed. You can once again, I'll show you where I've drawn the resistance line here at 113.50, where the resistance line is drawn in, and I'm connecting that to the medium term crossing over the long term predicted difference, and that did send a move lower, but now we're firming up. So for next week, 112 on the downside is very important to hold that area, and we need to retake this 18-day predicted moving average, and I would like to stay above that for the remainder of the calendar year. Again, if the dollar yen has any shot of returning back to that 116 level. Now, as we come into our main three commodity currencies, Aussie CAD, one of the daily trades this week, turned out to be a very, very good trade based on the weakness of the Canadian dollar and that strength of the Aussie currency. Now, we remain locked in this massive sideways action here between 129.20 and the 126.50 area. I talked extensively about that here and with my own direct clients about being very cautious of both bear traps and bull traps. Same types of traps I talked about on the dollar yen. Be careful around 111. Be careful around 114.50. So right now with the CAD, we need to break through this area and close above 129. And in all reality here, guys, we need to break above 130 and stay above 130. And that would require the oil contracts to sell off completely. Very, very mixed signal here. Still showing upward momentum. Now, a lot of people are wondering what actually happened here on Thursday on this flash crash on this particular pair. And this came from nothing more than a comment at a business luncheon in Toronto, Ontario, Canada, which is not far from me, where a comment was made from one of the Bank of Canada members, where they're saying how hot the Canadian economy is, and that's going to lead to more rate hikes. The Canadian dollar immediately strengthened rate across the board. So that's how in thin illiquid markets, one little comment can cause a big crash. But as you can see, VantagePoint was really not having any part of that. They were not buying into that. They remain steadfast that US Canada is moving higher, despite this very long bar and an overreaction from the market. So right now, we could be looking at a much bigger move to the upside, but my optimism on that remains heavily guarded at this time of year. I think we're going to stay range bound on this, but if oil sells off, that intermarket correlation will be the determining factor that sends this particular pair higher. Now, as we come into Aussie US and New Zealand US, guys, this really is a metals-based trade, and as gold is kind of stalled out a little bit, you can see that Aussie US has also. So is New Zealand US, but this is the same, in my respectful opinion, it's pretty much the exact same trade. People will buy Aussie US and they will sell New Zealand US. So this is not a normal practice here, guys. They're both commodity currencies. We trade one or the other. We don't like to trade both at the same time. You can see we've been in a tight channel, and this is once again potentially a classic bull trap. So if Aussie US is really going to move higher, we're going to hold above 75.94, and we're going to continue to advance past that. We do not want to slip back inside this channel, but unfortunately, guys, as you can see here, if I zoom this in so everybody can see this very closely on the 1 month time frame, this is what a bull trap looks like. We push through a known channel, but then we slip right back inside of it again. So this is telling me that gold is likely moving lower, guys, and Aussie US is probably going to follow that down with it. Same as New Zealand. I don't see a big difference here. Now, New Zealand is definitely more bullish than what Aussie is. We've got a nice cross on the 8-day over the 18-day, but we're still failing up here. The second gold move lower, that was the end of the rally. So understanding these intermarket correlations, definitely something we're going to be looking at in a live training room. That's going to be a very, very exciting training room to be involved in. That will be on Monday and Tuesday evening each week. It'll be a pre-market training room also, just to let everybody know, because as we all know, the Forex market is from 5 p.m. to 5 p.m. The new trading day starts at 5 p.m. Eastern Standard Time, and it ends at 5 p.m. Eastern Standard Time the next day. So we're going to be doing everything ahead of the market. So with that said, this is the Forex Weekly Outlook for the week of December the 18th, 2017.